Welcome to the Mike Litton Experience Podcast. Mike has over 31 years experience in real estate, finance, and investing. He's passionate about being a father, a teacher, a realtor, an investor, and a leader. Everyone has a story, and our passion is to help them tell it. And now, introducing the host of the Mike Litton Experience, Mike Litton.
So what can you expect from the Mike Litton Experience? You can expect stories that will inspire, motivate, advice that will sharpen your focus, and expert information on real estate, finance, and market conditions.
The theory is, or the thinking around it is that if you can't get the lunch orders or breakfast orders right for an entire trading desk, then why the hell should they give you the responsibility of actually trading real risk, right?
Right.
And so
people lots of money.
Yeah, exactly.
Yeah.
And Mike, what a lot of people don't get is they a lot of people I think are entitled now, to be honest. And they think that, hey, if they show up and do a decent job for 3 months, they should get paid more and get promoted. And the reality is they don't deserve it. They haven't earned anything. And it was much harder back in the day. And so, a lot of people back then were eager to do that job.
Yeah.
Like I never complained about getting there 5:30 in the morning. I never complained about getting lunch orders for 40 people. And if you got one thing wrong, like you were going back.
Yeah.
You were getting chastised too.
Isn't that amazing? What a change. I mean, it's insane, man. And what I found is the people, like we talked about before we hit record, the people who really succeed at a high level in this world have your attitude. They have your work ethic. They have the focus that you have. Like, you're just not going to take no for an answer. You're going to figure out a way to make it work. And if it takes accurate lunch orders, then so be it, right? You're going to get to whatever that end result is, no matter what it takes.
100%. It's about being relentless.
Yeah.
You have to be persistent and you have to be humble, right? In the sense that you can be very confident. I'm very confident. I don't doubt myself at all, but I'm humble when it comes to working with others and being willing to put in the work and prove myself first.
Right.
And so I think some of the things that always stand out to me in terms of what makes people successful, certainly what's helped make me successful, is one is relentless pursuit, right?
Mm-hmm.
Relentless pursuit of your goal, just never giving up, because most people are going to give up. And it does get harder before it gets easier. And so that saying, it's darkest before dawn, I really think that's true. I mean, at least in my own experience, every time things have been dark and I push through that, that's when the big breakthrough happened.
Yeah.
And if you think about what causes growth, it's about stretching yourself, whether it's in the weight room, putting in more laps around the track, more reps, whether it's writing long papers in college or after college, whether it's coming in early and staying late to learn your craft, it's all about that relentless pursuit. And so to me, that's number one, is just being relentless, being persistent, and never doubting that you're going to make it if you put in the work.
Right.
If you have faith in yourself and don't give up, or faith in a higher power, right, that'll get you there, right? And so that's number one, is just work ethic and persistence. And then I think having confidence in yourself is very important. A lot of people don't believe they can do something, and so they don't.
Yeah.
But if you believe you can, I mean, let me take a half step back. The way I think about this is we are what we think about, right? And we are what we think about, and we are a sum of all the small decisions we've made throughout our life.
Yep.
So if you're thinking positively and you're making consistently good decisions and you're working really hard to get those smaller decisions right and keep moving forward, even if it's slow at times, you will eventually get to where you need to go.
Yep.
And so that's what I try to always focus on myself when things get tough. I just remember, hey, one thing I can control is how hard I'm working. Right. And so just keep working. Eventually it'll get easier. And then when you have those big breakthroughs, savor them, because to be honest, 99% of my time is not necessarily like enjoyable at work,
Yeah.
right? It's hard.
Yeah.
And you're basically grinding 99% of the time to get to that 1% where you can actually accomplish something that's meaningful. And so you got to enjoy that when it happens.
No, I totally agree with that. I totally agree. And you know, this comes down to commitment, right? It comes down to dedication. It comes down to drive. It comes down to, and like you said, you have to control what you can control. And what you can control is never giving up, right? And keeping your nose to the grindstone and keeping your eye on the ball and focusing. Things are going to be thrown in your way. There are going to be challenges. There are going to be things that you have, obstacles that you have to overcome. You just have to be willing to power through it, right? And that's the thing that differentiates the people who succeed in life to the people that just quit. They just can't take it anymore. And it's, you know, and it doesn't matter what people are successful in. If you watch and you listen, and that's why I love this podcast that we do, because you find this journey and you find what people power through and how they just absolutely will not quit. No matter what happens, they will not quit. I had a guy on that is a very, very good friend of mine, and he went to a Tony Robbins seminar that was a week long. It was a transformational business thing, right? Business Mastery, I think it was called. And one of the things that Tony ingrained in him that week was, you are the average of the people around you, the 5 people around you, right? Your net worth. And so he goes out and he joins this entrepreneur group, this group of people who have built businesses, started businesses, all that kind of thing. They get in this conversation at the roundtable. He shared this on our podcast. They get in this conversation at the roundtable, and they're like, so how many times have you gone bankrupt? 6. How many times have you gone bankrupt? 5. How many times have you gone bankrupt? 3. Right? And they're going all the way around the thing. They get to my buddy and he goes, 0. And they all started cracking up. And he goes, why is that so funny? And they go, because you're not trying hard enough. Right? You're not powering through. You're quitting too much. You're not, right? You're letting risk get in the way. Do you know that after that happened, he has just taken off like a rocket ship in the last year? He's doing things today, Zach, he never dreamed of doing. Never dreamed of doing. The level of success he's achieved, off the charts.
I believe it. I mean, it's all about basically putting your nose to the grindstone and pushing through. And one thing I didn't mention, but it was kind of implied, but I should highlight it. I believe that we should all invest in ourselves.
Yeah.
One thing that I've done well is I've always invested a lot of time and money in my own education, right? And my own career development. Yeah. And so for me, that's kind of given me the safety net that I never had financially growing up. And we talked offline about how I'm finishing up a doctorate in business at University of Florida. I've got 2 master's degrees, one from Chicago Booth, another from NYU Stern in risk management. I've got the CFA charter, the Kaya charter. And people sometimes will say, well, why are you getting all these degrees? Like, well, part of it is I just love learning. And I know that I need to invest in myself because I didn't have a safety net, and I still don't, other than what I've created, right?
Right.
And so I wanted to develop that safety net, and the best way to do that, in my opinion, is to be so good at what you do and so educated that no matter what happens, there's always a seat for you somewhere. Yeah. And so the advice I give to people is, to younger folks, invest in yourself, work relentlessly hard. Never give up. Find really good partners and mentors. Like you said, you are kind of the average of the people that you spend your time with, and take risks, because if you're not taking risks, you'll never know what you can achieve. You sometimes have to just stretch beyond what you think is even capable. And it doesn't mean taking blind or stupid risks, but it means putting in the work and making smart risk adjusted decisions where you're going to go out and really see how far you can go. Yeah. And if you fail, when you fail, you're really just gaining experience. That's kind of how I think about it. And if you view it like that, then that mindset will get you through and get you to the next opportunity.
Yeah. When you succeed, you party. When you fall short, you ponder, right? You actually learn more from falling short than you ever will from succeeding. It's a big deal, and it's a big part of the journey. There are going to be times when doors are going to get slammed in your face. there are going to be times when you're going to come up short. You're going to take a risk and you're going to come up short. It's like that conversation of how many times have you gone bankrupt, right? You're not trying hard enough, that kind of thing. So, and I'm not suggesting that people do take stupid risks, but they do need to continually take risks, and they need to continue to learn. The beautiful thing about you is you've literally never stopped learning. From the minute that you started in this life, you've never stopped learning. And every time you had an opportunity to learn from somebody, you soaked it in, you took it in, and you used it, right? And that's a big, big deal. And it's a big deal for people to understand. And it's a lesson that I hope people are getting from this interview and from your life story. You didn't have to go to University of Chicago. You didn't have to get a master's degree. You didn't have to go to NYU Stern and get a master's degree in risk management. You didn't have to go to University of Florida to get your doctorate, which, I mean, this is all part of the building process for you. And this is exactly the right, I believe, the right plan for you to launch what it is that you're launching, and to do the things that we've talked about that you're going to be doing in the future. So, this is a big deal. And I think you're an amazing example for people in terms of how they should live their life. Never stop learning, never stop improving, never stop building that network. You've got a network from Swarthmore. You've got a network from your high school. You've got from Brookline. You've got a network from Chestnut, right? You've got a network from NYU. You've got a network from University of Florida. Think about that for a second. Everywhere you're going, right? You're not only learning, you're building a network. And it's all part of investing in yourself and building that machine that's you, that can make better decisions and to help advise people better. That's the biggest part.
Yeah, 100%. And one thing we talked about that I should highlight is, along with all the advice I mentioned earlier, I think it's really important to go into every situation trying to be helpful, right? And give more than you're expecting to get back. I don't go into situations even expecting anything back from anybody. My goal is just to be helpful where I can be. And eventually, hopefully the universe repays that. And if it doesn't, it doesn't matter, right? Because it still feels good to do. So I think having that mindset of being a connector and a helper, and really just going out of your way at times to help people is really important, especially if they're less fortunate. I mean, I don't spend much time now helping super successful people that already have everything they need, right? But I spend a lot of time still helping people that need it. Yeah. And to be honest, Mike, that's what really inspired me to start my own investment firm. And so the firm is called Applied Real Intelligence, A.R.I. And that was kind of a spin on AI, because everything's going to be AI based in the next 5 or 10 years. And I wanted to differentiate our firm a little bit and say, of course we're going to utilize AI, but ultimately we're going to still form relationships and make strategic investment decisions based on human intelligence, what I would call real intelligence. And so that was kind of the genesis of the name. We're applying real intelligence to solving investment problems and helping founders get funding they need to grow. And so what we do, just quickly, is A.R.I runs an investment fund called the A.R.I Senior Secured Growth Credit Fund. And what we're doing, Mike, is we provide growth capital through loans to successful startups. So imagine you're a founder and you've built your business out, and now you're generating revenue and you're doing really well, but you'd still like to raise some more capital for growth. Right. You might want to build out your sales or marketing team, you develop a new product, build out your tech stack, enter a new region, whatever it might be. You need some growth capital. And you don't necessarily want to sell more of your ownership stake than you need to, because at this point you've already kind of made it and you're thinking, okay, I could use some more capital, but I don't want to go sell right now because I think the company could be worth a lot more in the next few years. I want to retain that ownership. And so what we do,
well, like you said, it's a balance, right?
Yep.
So I want you to touch on that, because it's important that people understand, you can end up with, if you're just dealing with VCs, you can end up giving away 80, 90% of your company and end up with 10% of what you created. I mean, it's really, it has happened. And it's like, that is almost it's almost disincentivizing, right? If you can get to a point to where you can balance it and you can add some, you can keep more of your equity, you can balance it with some debt. I think it's a great way to go. I think what you're doing is brilliant.
Well, I appreciate that. And, just in terms of how it began, I just saw that there was a huge opportunity in the innovation economy.
Yeah.
And, that was fairly obvious, especially to younger people. So 5-10 years ago, I started to think, wow, all the talent is going to flow out of the top schools and institutions into technology, venture capital firms, and startups. Even when I was at Booth, for instance, this was 2012 that I graduated. A lot of my classmates at that time were turning down consulting jobs, banking jobs, trading jobs to go to startups. Or large technology companies, right? Like the Apples of the world, right? And so I thought, wow, this trend is going to continue because innovation is what creates value.
Yeah.
And innovation then is going to attract talent and it's going to create more value. And given how fast technology was evolving, I knew that it would be easier and cheaper than ever before for smart founders to build disruptive, scalable businesses, right? And now it's changed dynamic. It's changed incredibly with social media, because you can basically build a business from scratch, and with the right marketing campaign that has some virality to it, you can be known by millions of people very quickly and very cheaply. And so my thesis was that as the innovation economy grew and more quality startups came to market, they would look for alternative financing sources in addition to straight equity. And so that's where debt plays a role. It's not really meant to displace equity in its entirety. It's really meant to complement it. So if you were doing a raise and you said, okay, I want to raise $10 million. Well, if you did it all in equity, you'd be selling more stock, right? Than you'd probably like. But maybe you could do 6 or 7 or 8 of that in equity and do the rest in debt through a loan.
Right.
So now you raise the same amount of capital, but you as the founder are retaining more of that ownership. And so that's the way it really works. It's really meant to be 3 to 5 year loans that are there to complement the equity raise. It's for successful companies that want growth capital. It's not really meant for struggling companies. It's not like a last resort funding option, for instance. And that's a misunderstanding that a lot of people have. They think, oh, I can't raise equity, I'm going to go try to raise debt. It doesn't really work like that. The way it works is once you have demonstrated you can raise equity, lenders will be inclined to also provide you with debt because you're a good credit risk.
Right.
And so the way I think about it is, this is all kind of built on my background. It's what I want to do is create access to capital and minimally dilutive capital, where they don't have to sell too much equity for the best founders in the world, irrespective of where they live or if they're, what their race, gender, or ethnicity is, right? I want to identify the best founders, and I want to create access for them, because there's a lot of people out there who are really talented, who are building great companies, but they're not necessarily plugged into the VC ecosystem because they're not a white or Asian man who went to school on the West Coast and is plugged in the Bay Area, or they're not plugged in New York or Boston. And if you're not really in the Bay Area, New York, or Boston, it's very hard to get the same types of opportunities to raise capital. And so my thinking is really on the mission level. The mission is to create access for everyone, irrespective of where you live and what you look like. And it's really about funding the best ideas and the most relentless founders, right? Like if you pair a good idea with a founder who's got all the characteristics we talked about before, you're going to be successful as an investor. And the founders love it because our tagline at A.R.I is "You built it, A.R.I helps you keep it." So it's not hard for us to find many good deals, because every founder who learns about what we're doing is very inclined to utilize this financing tool, because they're like, man, I don't want to end up with 3 to 10% of my company. And like you said earlier, Mike, the majority of startups, especially the big unicorns that go public, if you look at how much the founder and the founding team owns at exit, it's a very small percentage.
Yeah.
And it might be a very small percentage of something big,
Mhm.
right? But oftentimes, let's say that you don't become a huge multi-billion-dollar company, but you wind up owning 3 to 5% of a smaller company. Well, that's not really that attractive, given you may have put in 10 to 20 years to get to that point.
So I'll tell you something that I'm seeing, and I'm not in your world, right? But I happen to have a friend of our family who went out and created a company years ago. And she was amazingly successful, incredibly successful. And she went out and she went the VC route, didn't have any debt available to her, that kind of thing. Went the VC route, ended up with a very, very small percentage of the company when it went public. Okay. Cashed out, had a non-compete, hung out, consulted, right? Waited for the non-compete to expire. Now she's creating something even bigger and even better in the same industry, right? And this time she's going to own a large portion of it. She's not doing the VC thing the way that she did before. She's absolutely determined that she's going to basically make this on her own. Okay. And the VC thing is going to be a minor part of it. That's what I'm seeing. And she's not the only one. I've seen other companies do this, other founders, where they've gone out and they founded it. They turned around, sold it, had their non-compete, all that, right? And then came back and they're roaring back, building it again.
And Mike, one of the themes that's very relevant right now that's related to that is a lot of founders now are really trying to bootstrap their companies, meaning they're using their own capital for as long as they can to get to profitability. Because the VC model historically has been raise a bunch of capital and spend it all quickly to get to revenue scale.
Right.
But what happens there is you might have a lot of revenue, but you're actually spending more to generate that revenue. So you're actually losing money every year. And so you don't actually have a viable business. Like if you gave me $100 million, of course I can go build a business that's doing $10 million a year in revenue. Right. But that what happened to that 90 million of capital? Right? It turned 100 into 10. That's not a win. Right. And so what founders are realizing is that model doesn't necessarily work that well for them either, because while they're going out and being encouraged by the VCs to raise more and more capital, they're diluting themselves every single round. I mean, the average round, you're going to give up, call it 20 to 25% of your capital, or you're going to sell 20 to 25% of your company's stock. So you do 4 or 5 rounds of cap raising, and now you're down to single digits, and that's usually what happens. And so founders are getting wise, and they're thinking, maybe I should grow more methodically. Maybe I should think about building a viable, sustainable business that generates profits, and the revenue numbers won't be as big and they won't scale as quickly, but I'll have a lot more control over the process. I'll have a lot more autonomy, and I'll quite frankly have a lot less stress, because when you're profitable, you can basically, you're going to be there in perpetuity. The business will last forever as long as it's profitable. But if you're burning cash every year and you're not profitable, you can go out of business if you don't raise another round. And that stress, is something that founders are thinking they don't really need that anymore. What they'd rather do, and I'm seeing this across the board, many founders, is they'd rather scale more methodically. It doesn't mean they're going to not use venture capital. They still are, but they're going to peel off smaller pieces of equity in each raise, right? And they're only going to raise what they need to take that next definitive step, as opposed to just raising a bunch and hoping that if they spend a lot, good things will happen.
Right.
And that's the theme. And I think that's the right approach, because what it does is it really vitalizes the U.S. economy, because most growth is actually generated by small businesses. It's not generated by the Fortune 500 companies. And so you've got all these fast growing smaller companies, and if they can all become profitable more earlier in their life cycle, that's going to generate more profitability and job opportunities for the broader economy. And so I think that this is generally a very good thing. And a lot of this was brought on by 2021, because it was so euphoric and there was so much money raised at absurd valuations that most of the companies that raised money in 2021 at very high valuations will never reach that valuation again. They're down anywhere from 50 to 95% in many cases. And so what they're finding is they're basically zombie companies. They can't raise any more capital because all their existing investors are underwater, and new investors don't really love the story, and are disappointed that they haven't been able to execute, and generate that valuation that they expected. And so there's a lot of folks now that are just really, they've been hurt by the good times. It's almost like all the gains were moved up from the future into 2021, and so there was nothing to be had later.
Right.
If that makes sense, right?
Right, there's nothing
And
left
so,
to take.
yeah. And so
Yeah.
now that the theme is really, hey, let's be more methodical about this. Let's figure out how to build sustainable businesses. Let's not get over our skis in terms of valuation or capital raising or capital spending. And I think ultimately it's good for everybody. And I'm seeing founders that are coming to market now really embracing that approach.
Well, I think what you're doing, I think I've shared this with you. What you're doing is brilliant. And part of it is this. A lot of these founders that have done this before were in a big time hurry to raise capital, like you're saying, right? And what they did was they signed off on losing a ton of capital because they thought they had no other choice. You're giving them an alternative, okay? Then when they sign off on all that, those VCs are now stockholders, and those VCs have a particular idea as to how you need to go about growing and how you need to go about running that company. And they've got this set of voices, right, that are driving them nuts. Okay. It becomes this stressful experience that they really don't want. They created this sort of monster that all of a sudden they just don't want. So once they get an opportunity to offload all that and come back and reset and do it again, like you're saying, that's when they come back and they start doing it for real, because they realize the mistakes they've made, like we talked about before, right? They realize the mistakes they've made and they're doing it better this time. And they have more credibility because they've already done it once, right?
100%.
Different situation, different playing field, the whole thing. And now you show up and you're like, hey, there's a way to do this with debt where we can equalize this. That's perfect for a lot of these people, right? Because they know they can pay the debt back. They have the confidence, they've done it before, right? And they don't want to give up that much in the way of equity. So I think, I mean, what you're doing is perfect, and it's in the perfect time frame based on a lot of the evolution that's happened.
Yeah, we're very fortunate in terms of timing. It took me longer to build the firm and the fund than I would have liked. And that was partially because of COVID, partially because it was a new strategy that very few people understood, especially investors, investors in the fund. They thought, wow, this, they heard the word venture debt and they got scared by the word venture, even though it's actually a very low risk strategy. So it took a while, but the reality is now we're perfectly timed because we missed all the bad things that happened and the bad habits that were developed in 2020, 21, and 22. And now we're coming in to fund the new wave of the best founders that don't have the bad habits that a lot of the other founders previously had. So it's perfect because we've got fresh money. We don't have legacy positions that are underwater like the majority of our competitors. So all of our positions are new, and they're all going to founders that are what we deem to be best in class, that aren't damaged. And for what it's worth, Mike, there's a lot of founders that I've met with that I think really did pick up some bad habits in that boom period of late 2020 through mid 22. And it's just it kind of goes back to what we're talking about with background. People who have gone through hard times and had to come from humble beginnings had a much higher bar to clear, right? So they had to be excellent at everything, and they had to work hard at everything, and they had to be accountable for everything. And so it developed in them the ability to handle anything. And what you don't see is when people have it easy, they think that that's what they're entitled to. They think that that's what they should expect. And then when things change and they have to really, grind, they're not prepared for it. And so, at a big picture level, this is real. This psychological, this psychological, outlook essentially is really damaging for founders that had it too easy, because they still have this sense of like arrogance and entitlement. And the reality is most of their businesses are probably what I call zombie companies. Like they're never going to make it because they're not profitable and they're never going to be able to raise enough capital to get there. And the people that are going to be successful are these founders that have had it harder. And right now, trying to raise capital is very, very difficult. So if you're able to raise now, that that demonstrates that you have your act together. Like if you can raise now, you can definitely raise in a bull market, right?
Absolutely.
And so that's one thing I think a lot about is digging into the backgrounds of founders to understand what they overcame to get to where they are.
Yeah, that's the beauty of what we do here. It's cool, man. It's cool. All right, so we're at present day. You're finishing up your, how soon do you finish up your PhD?
So I finish my doctorate next August. I graduate, but I'm basically all done with classes. I've got 2 classes I'm finishing up now, and then it's on to the dissertation for a year, and that'll be pretty cool. I'm doing my dissertation under the head of the finance faculty at the Warrington College, and he did his PhD at University of Chicago in the 80s under now I'm drawing a blank on his name. Eugene Fama, sorry. So it's pretty cool because Eugene Fama was kind of the theorist who really talked about efficient markets and developed a lot of the methodology that we use today in
the father of modern economics.
Yeah. So Mike Reingart's my advisor, and he did his PhD under Eugene Fama. And so it's kind of cool just to have that, connection given my connection to the University of Chicago as well. So that'll be good. And part of the reason for doing the doctorate at University of Florida is I think it's a fantastic school, and I love how engaged their alumni are. As good as Swarthmore and NYU and Chicago are, their alumni engagement leaves a lot to be desired because they're all Division III schools with no sports teams that are any good, or certainly not at a national level. And University of Florida, you've got 500,000 plus alums, and they're very engaged. For instance, when I would go to the gym in Venice, California, right near where I lived in Santa Monica, if I wear a UF hat, I'd have a bunch of people stop me every day and say, "Hey, go Gators," and they'd be really inclined to have a conversation. And so it opened up a lot of doors just through that, let alone all the other doors it'll open. So a big part of it was just accessing a great alumni base, but also my thinking that the Southeast US is really going to be a growth hub for innovation going forward. I think we've reached what I call peak Silicon Valley. In other words, it's the San Francisco Bay Area has had its peak. There's still going to be great companies and people coming out of there because they've got an entrenched ecosystem. But the reality is you don't have to live there anymore to do big things. And I think a lot of people are realizing it makes a lot of sense to live in Florida or other regions in the Southeast for lifestyle reasons, cost of living. There's a whole slew of reasons to live down here. And so you've got a lot of talent, both young and old, migrating to this area. And quite frankly, there's very little in the way of VC and venture debt down here. And so my view is that our goal is to be the #1 venture debt provider in the Southeast US, sooner than later.
Yeah, that's cool. That's cool. Okay, so what's next?
It's really just building. It never really stops. And so
I'm looking forward to referring to you as addressing you as Dr. Ellison. This is going to be fun.
I think what's next, a couple of things. One is, we're going to start deploying a lot of capital now to great startups and relentless founders. And so there's a bunch of deals we'll announce starting this summer. So that's exciting because a lot of people have been waiting on that. They've seen me building and spending a lot of time educating people on venture debt and growth credit. But they were wondering, hey, is this guy ever going to deploy capital? Is A.R.I ever going to deploy capital? And now we're there. And so that's going to be a huge step because these are these are very attractive investment opportunities because we are identifying great founders with big potential and the ability to not only pay down, the debt, but also generate some equity upside for us as well. Because typically with these loans, we're not only providing them with debt, but we also have some equity upside to align long-term interests.
Gotcha.
So we're very incentivized to help the companies do well, even after they've repaid the loan, because we have some equity stake.
Gotcha.
It's a lot smaller than it would be if we were a straight equity investor, but it's enough to make it material.
Sure.
And so the next step really is just helping the companies that we're investing in really reach that next level. And so this is what I've been waiting for. And this is what I'm most excited about, right?
Yeah.
Like all the other stuff was not fun. Building out a fund and a company from scratch with all the regulatory hurdles is not easy.
Yeah.
Raising capital is brutal. So I know how hard it is for founders. So I've had to do it myself. And so that's, that was a tough slog. And now I get to do what I really enjoy, which is partnering with great people who I can add value for in terms of maybe it's strategic advice, maybe it's networking, connectivity, helping them, kind of as a sounding board in many cases. And so that's where I think I'll be spending most of my time over the next couple of years, is just really investing in these companies, but then after we've invested, helping them grow and reach their goals. And that's where I think the most fun will be had.
That's cool, man. Well, I'm excited for you. I'm excited for the future. So if people want to reach out to you, it's Z Ellison at ARIVC.com, right?
Yep. So
ARIVC.com, right?
Yep. My email is zellison@arivc.com. And then our website's www.arivc.com.
Gotcha.
And I'm very easy to find on LinkedIn as well. I'm pretty active on LinkedIn. So just Zack Ellison, it will probably bring me up to the top of the page in most cases, and love to engage there. And I've also got a podcast called The 7 and 7 Show that's on Spotify and Apple and everywhere podcasts are found. And that's actually a very relevant show for both investors and founders. Season 1, I interviewed mainly top tier chief investment officers from leading investment firms to understand how they invest in the markets and what their fundamental investing principles are. And season 2 has been mainly with VCs talking about how they invest in innovation, how they identify good founders and good companies at early stages. And so I think, it's a niche audience certainly, but if you're a founder or you're an investor who wants to get involved in innovation, I think they're actually really insightful. So that's one thing I do. And then the last thing I'll mention is I write 2 columns. One for Venture Capital Journal, which is focused on venture debt. So that's a monthly column. And the other is for Built In, which is a website that really helps technology startups grow. And the Built In series is really geared towards advice for founders. So I basically got 2 audiences. One is institutional investors that read Venture Capital Journal and want to learn about how to invest in venture debt. And the other is founders who are looking for advice on a whole slew of things.
Yeah.
And so those are both good reads. And last but not least is my newsletter, or A.R.I's newsletter. It's called Uncommon Sense, spelled sense is CENTS.
Yeah.
Like Bond sense.
Yeah.
And so that's pretty good because all that material, the podcast, the 2 monthly columns, all that's available in the newsletter for free. It's also available on the website for free as well. But if you actually go to Venture Capital Journal, it's behind a paywall and it costs, I think, $2,500 a year to access it. So a lot of people would rather read it for free directly from the newsletter.
Absolutely. So you're going to write a book one of these days, and I want you to come back on and talk about it.
I'd love to. Maybe I could even get you in the book, because
I'd love it.
It's going to be all about funding innovation and funding earlier stage companies. And part of it will be on venture debt, of course, but part of it will also be on equity financing and really how founders should be thinking about building their capital table from the beginning, and so that they don't screw it up. And also for investors that want to invest in innovation, helping them understand what their options are in terms of early stage equity, later stage equity, venture debt, publicly traded tech companies. I mean, there's a lot of ways to invest in innovation. And so this will help them really define and understand what they are getting with each of those options.
Awesome. Well, I'm looking forward to this, man. This is really cool. I'm so glad we had an opportunity to meet, and I have thoroughly enjoyed every second of this. Zack Ellison, thank you so much for being our guest on the Mike Litton Experience.
Thanks, Mike. Thanks for having me.
Appreciate you, buddy. We hope you enjoyed another episode of the Mike Litton Experience. If you did, do us a favor, smash that subscribe button, tell your friends, family, and coworkers about our program, and wherever you get your podcasts, please leave us a rating. It helps us to connect with quality people just like you.
And that's a wrap. Another episode of the Mike Litton Experience in the books. Reach out to Mike on Instagram at Litton Realty. Want to meet with Mike? Check out calendly.com/Rio760.